In this week's video, we'll cover the 3 most important questions facing investors over the next 20 years that could significantly impact quality of life. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Question number 1. Are we open to all outcomes, from much better than expected to much worse than expected? Since the pain of the dot-com bust and the pain of the housing crisis are relatively fresh in our minds, most investors can conceive fairly easily of worse than expected outcomes. Also, given those two events, it's easy to understand why many investors have trouble with the other end of the spectrum, much better than expected outcomes over the next 20 years. Having said all that, let's start with a quote from a recent post by Morgan Housel. You can find it at thecollaborativefund.com. The title is The Seduction of Pessimism. Hearing that the world is going to hell is more interesting than forecasting that things will gradually get better over time, even if the latter is accurate for most people most of the time. Pessimism can be hard to distinguish from critical thinking and is often taken more seriously than optimism, which can be hard to distinguish from salesmanship and aloofness. Over the next few slides, we'll review some historical and present-day charts to help us answer the question, is it more likely that the world is going to hell, or is it more likely that things will gradually get better over time? It's a monthly chart of the NASDAQ Composite Index from 1992 on the left side of your screen to calendar year 2014 on the right side of your screen. We're using monthly moving averages, and we've removed volatile price so we can focus on long-term trends. The blue moving average is a simple moving average. The red moving average is a little bit faster. It's an exponential moving average in terms of the way that it's calculated. We'll review this period in history and then apply it to the present day to see what we can learn. This is calendar year 2000 here, when the NASDAQ is peaking as the dot-com bubble is bursting. This is the beginning of the financial crisis. This is calendar year 2007. We can see these major peaks have two things in common. Number one, there's quite a bit of white space between blue and red, discernible white space between blue and red. We can also see that the slopes of both moving averages eventually flip from bullish to bearish. The slopes flip from bullish to bearish. After we can see this, really bad things happen for a long period of time. After we can see this, measure it, put it in a model, bad things happen for a long period of time. A major buying opportunity looks quite a bit different, but it does share some similarities. In both cases, we have white space between the moving averages. We can see quite a bit of white space here, quite a bit of white space here, and as you might imagine, instead of the moving averages rolling over in a bearish manner, in this case, they turn up, both of them, in a bullish manner. Since not all points in history represent major turns, we should also look at continuation type patterns. This is 1994 here. You can see our moving averages get somewhat of a toppy look here. Blue, there's white space in here. Blue is rolling over. But instead of rolling over in a bearish manner, we move from a toppy look to an indecisive look, and then we turn back up and have a tight look here. After that, good things happen for a long period of time. Similar situation, somewhat of a smaller example in terms of duration. We get the white space, that toppy look. Instead of rolling over, we're indecisive in here a little bit, and then we turn up and get the tight look of the moving averages. See how tight the moving averages are here and how tight they are here. In both cases, good things happen on the other side of this setup. So if we fast forward to the present day, does it look like a major top, a major bottom, or does it look more like one of these toppy and indecisive tight periods? If we extend the chart out to June 14th, 2017, it's pretty easy to see that we did have somewhat of a toppy, concerning look that's similar to these turns here. But in this case, instead of rolling over, we morphed into that flat, somewhat indecisive look, and our moving averages turned back up in a bullish manner, and we have a similar tight look here. This period here looks similar to this period here, and somewhat similar to this period here. In the 1995 case, good things happened for approximately 5 years after the setup, and in the smaller but similar 2013 version, good things happened for 2 years after a similar setup. This point here looks similar to this point here, which looks similar to this point here. In the next slide, we're going to move out a little bit further in time to start looking at some differences between these periods. Now we're looking at the exact same moving averages, but we've moved from 1982 all the way out to the present day. Present day looks similar to that setup in 1995. And if we look backwards prior to the setup, we also have some similarities. We have a jarring emotional event here in the form of the 1987 stock market crash that occurs before this look. And in this case, we have a very jarring emotional event in the NASDAQ in the form of the dot-com bust. This is a harsher and longer duration event here, but it has very, very similar psychological impacts in terms of it was very, very difficult to forget the 1987 crash after it happened, and it was very, very difficult to forget the dot-com bust after it happened. In both cases, after the jarring event, not surprisingly, markets went sideways in somewhat of a consolidation pattern. This setup here looks similar to this setup here. We also have in both cases the moving averages making a discernible higher low. A discernible higher low. This low is discernibly higher than this low here. We have white space on the bottom, white space on the bottom. In both cases, we had a breakout from the box. After the breakout, we rallied into the indecisive period. A breakout from the box, we rallied into the indecisive period. You may have already picked up on one of the major differences between this setup here and this setup here. We know the longer a market goes sideways, the bigger the move we can expect to get. And if we compare and contrast these periods, it can help us overcome that lure of pessimism. Good things happen for a long period of time after a 5-year consolidation in the moving averages. In this case, we have a much longer period of indecisiveness. This is a spring coiling for 5 years, then good things happen. This is a spring coiling for 17 years. We can also combat our fear of bad things happening by reminding ourselves that the present day, June of 2017, this look here doesn't look anything like this look here, this low probability look, and it looks quite a bit like this period here and this setup here, and after this point, good things happened. We can make an argument based on the 17-year consolidation box versus a 5-year consolidation box that not only could good things happen out of this look, but instead of getting a 5-year move on the other side, we could get a move that lasts much, much longer in duration. The facts that we have in hand, we can see this. These are observable, indisputable facts. The look of this chart here is a fact. It's not a forecast. This is a fact. This is a fact. All of these facts help us remain open to all outcomes, including the very, very difficult, better than expected outcomes. Next, we'll quickly scroll through some more historical and present day charts to help us reinforce the need to be open to much better than expected outcomes over the next 5 to 20 years. As we scroll through these charts, we want to be asking ourselves, relative to the economy and the markets, is there any historical basis to make the statement that things will gradually get better over time? This is the Dow 1930, June of 2017. We know from past videos that consolidation is often followed by good things. If you get a bullish breakout, consolidation followed by good things. We have consolidation here. From a mindset perspective, most people would have laughed if you said the market was about to gain 312% over the next 16 years from this point here in the 40s. And I know that most people would have laughed if you told them that the Dow was about to go up 1,000% over the next 18 years. If you told that to a conference room full of people in 1982, your credibility probably would have been out the window. And yet that is exactly what happened, despite the rampant skepticism about the United States and our economy in this area here. Given that good things can happen for a long period of time, good things can happen for a long period of time after consolidation, it's reasonable to assume it's in the realm of possibility. We're not making a forecast here, that based on this move and this breakout here, that the Dow could rally into the 2030s from a calendar year perspective. NYSE Composite 1965-2017. The early 1980s here, we get a breakout, then what looks like a failed breakout, and that morphs into a successful retest look here. Price was inside of the box for 18 years, and that was followed by an 18-year rally. Harder markets are followed by easier markets. And a very hard to wrap your mind around gain that occurred over that 18 years if you look from the early 1980s here. Similar situation in the present day. Consolidation, a bullish breakout, then it looks like we have a failed breakout, and now it looks like we have a successful retest in June of 2017. In this case, we moved sideways for 18 years, this case roughly 19 years. Therefore, it's in the realm of reason, if we can get a move like this with this type of magnitude, that it's possible, it's not a forecast, that the NYSE Composite could rally into the year 2034 based on this breakout here and this move here. How about the NASDAQ? Also had a breakout look here with a little retest here. You can see we come back and kiss the top of the box. Harder markets followed by easier markets. This is a 9-year rally. Similar look here, consolidation, bullish breakout, a retest here, now a successful retest look. This point here is similar to this point here. And after a 5-year consolidation period, good things happened for 9 years, and not many people would have guessed that this market was about to go up 943% from this point here in the 1990s. Just as it almost seems laughable to think that the NASDAQ could rally to the year 2022 or the year 2037. It's a similar look here to this period here. The only difference is the consolidation box is much, much longer. To be specific, it's roughly 4 times longer than this move here. If we feel like the world is going to hell in the present day, is there any basis economically to say that things will gradually get better over time? If we look at U.S. gross domestic product, or GDP, this is 1947 here, 2017 here, it's pretty easy to understand the concept that things will gradually get better over time. There's lots of gloom and doom on this chart here, geopolitically, economically, you name it. It's been mentioned somewhere in here, and yet things have gradually gotten better over time, and the economy has continued to grow. The slope and consistency of this line here is a pretty strong argument for the concept that things could get gradually better over time, which is exactly what's happened looking back to the 1940s in the United States. And this chart of GDP really doesn't support the concept that the world is going to hell, at least based on past history. To summarize, this chart of GDP and this point-to-point move in the Dow here from 1932 to 2017, both of these charts support the concept that things could get gradually better over time, because that's exactly what's happened when we look backwards. We also have numerous charts that support the fact that markets tend to consolidate and then pop, consolidate, and possibly pop. Given the fact that greed and fear and valuations are more directly involved in the financial markets relative to the economy, markets have a tendency to overshoot, then consolidate, while the economy tends to be a little bit more consistent. Based on the facts that we have in hand right now, 2017 to 2037, we really have no reason to believe that things can't get gradually better over time. A lot of pessimism on these charts here, and that's exactly what happened. Things gradually got better over time. The charts also say that stocks are trying to leave a long-term consolidation phase, and if that's the case, we may be entering or in the early stages of a 15 to 20-year move in the financial markets. We also know based on history that if that is the case, that volatility will be part of the equation when we move from point A to point B, and that will lead to many common missteps, telling us that it's extremely important to stay focused on the primary trend. If we focus on the primary trend, it's much easier to navigate from point A to point B. If we start looking at short-term outcomes and we start checking boxes here in the common missteps list, it's going to be very, very difficult, if not impossible, to navigate from point A to point B. Every primary trend has volatility and counter trends within the context of the established trend. It's extremely important to note we're not forecasting here. These bullet points are based on the facts that we have in hand. We just walked through the charts. If the facts change, we have to be willing to adjust as needed. The only way that we can do that is if we maintain that important maximum flexibility 100% of the time. Why are these important caveats relevant? Because if we don't keep an open mind about all outcomes and we don't maintain maximum flexibility, it's going to be very, very difficult to discern between volatility to ignore and what we know eventually will come volatility to respect, which is exactly what the model helps us with. It's also extremely important to note the term consolidate somewhat glosses over the fact that these periods can be extremely painful, and if you don't have a game plan for the worse than expected outcomes, these periods can also be marked by countless sleepless nights. Let's put some context around those comments. Now we're zooming in on the volatility to respect portion of that Dow Jones Industrial graph. Even dividend-paying established blue-chip stocks were hammered in this period here. From peak to trough, that's a loss of 54%. And we know from past videos that our trend-following techniques, something as simple as the slope of the 200-day moving average, can help us discern between volatility to ignore and volatility to respect, giving us some realistic hope of mitigating this big hit here to our portfolio. And when we look at the potential gain during a volatility to ignore period or a long-term secular uptrend and a volatility to respect period or a devastating bear market, it provides a good segue back to the main topic of this week's video, the 3 most important questions for investors. Number 1, are we open to all outcomes, from much better than expected to much worse than expected? Number 2, how will we handle much better than expected outcomes? And number 3, how will we handle much worse than expected outcomes? These hypothetical tables here help us understand why these 3 questions are so important. If we're not open to all outcomes, including much, much better than expected outcomes, it could significantly harm the quality of our life. Hypothetical. Let's say the present day turns out to be the early stages of a new long-term secular uptrend, which is exactly what the charts are telling us to be open to. And we invested $600,000, and the Dow moved in a manner over the next 18 years that was similar to the move from 1982 to 2000. That would be a gain of over 1,000%. Our $600,000 would be worth over $6 million, and if we retired at this point here and took 4% annual income off of this portfolio, we would be pulling in $273,000 per year. Conversely, if we're not open to and we don't have a game plan for much worse than expected outcomes, and the next few years looks more like this, then our $600,000 could lose 54% and turn into $276,000, and income off of that at 4% is $11,000 per year. The spread gets even bigger if our portfolio is $1 million or we start with $3 million in the present day. So if all three questions and bullet points apply to my investment game plan and outlook, that means that I would be open to better than expected things happening, which would allow me to formulate a game plan. How will I handle a situation like this if the markets greatly exceed expectations over the next 5 to 20 years? If I have that game plan, it could significantly impact the quality of my life. Conversely, if I'm open to all outcomes, including worse than expected outcomes, I could mitigate some of this loss, which could be devastating to the size of my portfolio and could adversely impact the quality of my life later on. Markets have been more volatile lately. We have to keep our eye on our main objective, which is navigating from point A to point B in a prudent manner to capture a reasonable amount of the gain from point A to point B. And when we move into volatility to respect, it's the exact same game plan. The only difference is the primary trend is down, and volatility to ignore is counter-trend rallies that move in a bullish direction. The concepts are exactly the same. Volatility to ignore between point A and point B would tell us to maintain our defensive posture, to continue to own bonds and similar instruments during the normal and 100% to be expected counter-trend rallies that occur during a primary downtrend. Conversely, volatility to ignore here tells us to try to remain invested in a growth-oriented manner during 100% to be expected volatility to ignore, which is pullbacks within the context of an ongoing uptrend. No matter what happens in the future, one thing we know for sure, the markets are going to be very, very difficult. We can improve our probability of success by focusing on the primary trend, maintaining maximum flexibility 100% of the time, and trying our best to avoid these common missteps. And if we're able to do all that, we could greatly enhance the quality of our life going forward. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shervacco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.